Good afternoon, everyone, and thanks for joining us for the seventh and final session of the 2023 ERC Update Series. My name is Marty Kerriman, and I'm the leader of our tax credits and incentives advisory practice within strategic tax here at Bekaert. I think we have a pretty good presentation for you today. We're going to be offering up to 1 hour of CPE. And with that, I'm also pleased to introduce one of my colleagues, Deb Walker, who's our compensation and benefits leader, who's going to help drive today's session on what we call mastering preparations for ERC in 2024. And just to summarize what that means, I think the intention here today is to give both background on the credits, history, and also a summary of where we are as we move into 2024, as the statute of limitations begins to approach for the 2020 ERC, where the IRS is, red flags, things for which to look out, but we'll leave it at that. So we're going to talk about ERC background. We're going to talk about the IRS program to withdraw claims. We did that last month. We're going to add some more color to it. The IRS moratorium, exams and audits, income tax adjustments, which is interesting stuff because there is an income tax interplay with the employee retention credit, and overall benefits of working with an accounting firm. With that, we'll move on. All right, so we have 4 polling questions today. Here's the first one. Have you or has your company applied for the employee retention credit? A is yes, B is no, C is not sure if eligible, and then the last one is holding off because of the IRS moratorium. I have seen a number of companies who hadn't claimed it, who hadn't looked at it or took another look at it, decide to hold off due to the IRS moratorium, which we'll get into the specifics on that. But our general thought is that it makes more sense to claim and file it than wait till the moratorium's over due to the fact that we do have a closing time for our statute of limitations for 2020. All right, we'll see how this one works. Give it a minute. And Deb, while we're doing this, why don't you introduce yourself for a moment?
Mute. My name's Deb Walker. I've been working with Marty since we started up the ERC team. I did a little bit of PPP work before, and throughout my career, I worked with KPMG and Deloitte, and then spent some time at Treasury. So Treasury, where we work with creating the laws and the guidance, has really been invaluable to me in understanding sort of what all the guidance means and able to help others understand what it means.
Yeah, absolutely. All right. I don't see the results there, Lindsay, but maybe we move on, or how does that work? All right, good stuff. So let me start here, just a background for everybody in terms of the employee retention credit. There are 4 employee retention credits. There is one for the period of March 13th, 2020 through December 31st, 2020. And there are then 3 more that line up exactly to each of the first 3 quarters of 2021. The 2020 was passed in 2020, actually, once COVID began. And then later on through enhancements, law changes, et cetera, there were 3 more credits ultimately added. The credit amount for the 2020 credit can be as high as $5,000 per employee. It's essentially 50% of the first $10,000 paid to each employee for what's known as small employers, to the extent the employer itself or the business is treated as an eligible employer, meaning they qualify for the employee retention credit, either under what we're going to see later, the gross receipts test or the government order test. The 2021 credits are actually more generous. They are as high as $7,000 per employee, equal to 70% of the first $10,000 paid to any employee for a small employer, which means you can max out at $21,000 per employee in 2021. Statute of limitations for 2020 closes April 15th, 2024. And then we have 1 more year after that for the statute of limitations to close on the 2021 credits. Excuse me. Let's move on. All right. These 2 slides, this and the next one, are similar, but they go through the rules in terms of what makes you eligible for the employee retention credit. In 2020, you follow either what's known as a government order test or a government mandate test, essentially trying to basically you analyze whether or not you as an employer are subject to government orders limiting commerce, travel, or group meetings that have an effect on a more than nominal portion of your operations, such that the government essentially is shutting down your business, and yet you keep people on the payroll. That's essentially what this is it's rewarding you for keeping people on the payroll when you couldn't do and operate fully. Essentially, you are operating through what's known as a partial suspension of operations. That is generally when we look at the government orders and how they apply to the business itself. To the extent those government orders are causing a market disruption or a disruption to the customers or those that pay the potential eligible employer, the gross receipts test is used, and you can use one or the other, but essentially you're looking to see whether or not the gross receipts, basically the revenues plus, we'll say, interest, dividends, rents, royalties, and some other income items in any quarter of 2020 is more than 50%, the gross receipts in any quarter of 2020 suffers a more than 50% decline as compared to the gross receipts of that same quarter in 2019. For both the 2020 and 21 credits, we're analyzing back what took place in 2019. So that's a pretty onerous test to show that you have a 50% decline, but certain businesses certainly did suffer that, and we worked with a number of them. But I would say in 2020, the more common method of qualification is the government order test, especially when you were doing it back in real time, when you didn't know what your gross receipts would be toward the end of the quarter until you got there. All right, let's move to the next. In the 2021 credits, the rules are similar, but they're more lenient in the sense that under the gross receipts test, a business would only need to show a more than 20% decline in their gross receipts as compared to that same quarter in 2019. It was also expanded out to apply to public colleges and universities, and also some hospitals as well. So some arms of the government, but to the extent they were public colleges, universities, or hospitals, they could also qualify for the employee retention credit in 2021. Government mandate test stayed the same, but practically speaking, what you saw is harsher government mandates in 2020, and then those that started to lift in 2021. So early on, I used to say that the most common test for the 2021 credit was a gross receipts test because you only need to show more than 20% decline. But as this ERC became highly, we'll call it marketed by some of the ERC mills out there, it was pushed, I would say, on a number of taxpayers to look at the government order test and then also to try to fit into one of the examples the IRS came in, which is the supply chain potential method of qualification, essentially saying that, like, if you as a business did not suffer or have any government orders on you, to the extent your supplier did, that might have the ability for you to then claim that you were a sort of by a transitive property, an eligible employer. We may get to this in some later slides, but I'm just going to say that that supply chain position was highly utilized by a lot of ERC mills out there, and I think not well documented, to the extent that the IRS came out with some guidance late summer, I believe it was August, indicating that to the extent you were claiming that a supplier suffered a disruption and that supplier's disruption caused a disruption to you, you would need to identify the name of the supplier, the location of the supplier, the particular government order affecting that supplier, and the duration of that government order. And then beyond that, how that lack of supply had a impact on a more than nominal portion of the claimant's business. So it's not just as easy as saying there's sort of supply chain disruptions out in the air. It's which I have seen a lot of ERC mills make that position without much more documentation. Yeah, go ahead.
Well, and Marty, while we're talking about this GLAM, it's a General Legal Advice Memorandum 2023-005 that talks about the partial suspension of a supplier. The IRS gave 5 different examples of situations in which a mandate for the suppliers may not have resulted in a partial suspension for the business that's claiming the credit. And the examples included things like you didn't get your supplies, so your inventory dropped. And from the government's perspective, they would say, well, the fact that you had to draw down on your inventory doesn't mean that you had a partial suspension, even though your supplier may have had a partial suspension. So And then, so my point is there's 5 examples there, in addition to the onerous documentation that you're going to have to give to the IRS if you're relying on a supply chain disruption. They have expanded to what a lot of people would have said, well, I had a partial suspension because I didn't have the inventories that I normally carry. The other one was a retail store that couldn't get some products at all. So I think that employer said, so I had a partial suspension. I couldn't get products. Although the facts were that they sold other products or they found alternative suppliers. And so from the government standpoint, they go, well, the fact that you could sell other products and find alternative suppliers for the supplies that you couldn't get means you didn't have a partial suspension, even though your suppliers had a partial suspension. So I think, and a lot of people are criticizing the GLAMs as being too onerous. So you will find people who take the position that's not supported by the GLAMs. But obviously, the position the IRS is going to take is exactly what they've laid out in the legal memorandum, and you can expect to have some disallowed claims if that's, if those are your facts.
And we've been successful in this space, working with clients on the supply chain disruption argument. It's just you really need to identify what those particular government orders were and their effect throughout the chain, and all the other things that Deb just described as well. It's not enough to say, I read an article that there were supply chain disruptions out there, which is what I've seen happen. It's one of the examples in the IRS guidance as well. Another thing that we've seen a lot of from some of the ERC mills out there was instead of referencing a particular government order specific to COVID-19 that limited commerce, travel, or group meetings, instead, the company who was claiming it, or its provider, or its ERC mill doing it, essentially would just look at CDC and OSHA guidance. And then we saw earlier this year, very recently, the IRS come out with another legal advice memorandum indicating that OSHA guidance is clearly not enough for purposes of being an appropriate government order for purposes of this. So if you made a claim via OSHA guidance, maybe you receive the funds, or you're waiting for the funds, or you're thinking about what your audit risk may be in terms of utilizing that cash, certainly some of the stuff that Deb's going to talk about in a moment with respect to what some of the methods of pulling back a claim may be, or how we defend a claim going forward. We'll talk about a lot of this stuff right now. So it's just, those are two of the most common areas. The OSHA and CDC guidance just cited, because that clearly existed long before COVID was around. And then beyond that, also this supply chain disruption thing, which is interesting as well, Deb, because they say that these GLAMs are too onerous and restricting supply chain disruption. But the supply chain disruption is, like, fact pattern is nowhere in the statute. The IRS actually gave that to taxpayers in the notice. So I see a lot of these ERC mills out there saying the notices, I'm not following them, but I am claiming a supply chain disruption, which is totally a bit oxymoronic due to the fact that, like, it was invented by the IRS as a method for taxpayers to claim. So just that's a little bit of extra flavor on it for you guys following today. So why don't we move on to the next one? Okay, IRS moratorium. Let's move to the next slide. Deb, you want to take this one over? I can certainly kick it off, but why don't you begin, if that makes sense?
I think the IRS was very overwhelmed with all the ERC claims. At one point, they said they thought 95% of what came in was fraudulent. I don't believe it's that high, but it could be. And so they decided, or the commissioner decided, that it was better to take the heat for stopping processing than it was to process claims and later take heat for having paid a lot of fraudulent claims. So the IRS has always looked at data that they have and questioned some claims before they're paid. Now they've stopped processing anything that was filed on September 14th or after, and they say that they will open up, and the moratorium on processing would last throughout the end of 2023. Most people think it won't start until February or March of 2024. But this pause is, in our mind, you should certainly be filing claims now so that you get in queue, especially because you want to be able to file the claims, the 2020 claims. We only have 5 months left until or 4 months left. Friday, it's going to be 4 months until the statute of limitations on filing those claims runs. So you want to be able to make your claim and get it to the IRS and have it gotten and be able to determine that it's in their system. So before the statute of limitations expires, we have claims that are lost in the mail. We have claims that get to the IRS but never get in the system. And you sort of need to monitor what's going on at the IRS by checking on your claim and making sure it's still in process.
All right.
I think we should move to the next slide.
Agreed.
Why did they halt the claims, the halt on processing? They wanted to take people offline that were processing and then develop some more rigorous review of the claims that are being filed. We have no idea what that rigorous review is going to be. In some cases, I think they may send out letters asking for more information that they can't find in their own files before they pay the claim. So especially where you have a supply chain disruption in the third quarter of 2021, or a government mandate in the third quarter of 2021, or you live in a state that didn't have very many mandates, then, or operate in a state, only in a state that didn't have many mandates, then I think that you might have questions before the claims are paid. As I said, it's important to check on the claims. That's why we left the number on the screen where anybody can call. It's a long time to wait, but you just sort of have to multitask and do something else. They're open 7 to 7 local time. I call very early in the morning, 7 o'clock Eastern time, but I can also get in later in the day because as they move across the country, 7 to 7 local time, if you call it 7 o'clock, you're going to get somebody from the West Coast to answer, and there's fewer people calling that late. Unfortunately, all you do hear is the claim was received, it's in process, or a refund's been issued. But
yeah, and beyond that, I think, Deb, as well, they took a pause here on processing in order to provide some additional processes for taxpayers to pull their claims back. And so that wasn't developed when this came out. Later, it was, and we'll talk about that in a moment. So let's move on. Just so you know, it's this again. Why did we say it specifically? Beginning September 14th, right? The moratorium hit. It was announced, and the reason, again, as Deb was saying, there was testimony on this in front of Ways and Means Committee, and it had been articulated by the service as well, and some notices that they saw a lot of warning signs of aggressive promotion. That could mislead people into making improper ERC claims. What they were most concerned about, I believe, beyond the backlog that they had, was taxpayers being talked into claiming an employee retention credit when they may not have qualified, because you might have seen quite a bit of advertising on the employee retention credit. It was almost everywhere you went, and you were getting robocalls on it as well. And so everybody thought they qualified for everything. And then part of the reason for that is these ERC promoters we're saying that this OSHA guidance was enough to create a government order, and then they were assuming, without doing the work, that it caused a partial suspension on the business. And so there was a real lack of connection between, it was a tenuous government order at best, but it really wasn't one, as we now seeing this OSHA or CDC guidance. And then there was no analysis about how it caused a partial suspension, or no real financial analysis. So we ran into that quite a bit when we did not perform the employee retention credit analysis. We saw it performed by some other consultancies out there for some of our audit clients, where we had to review that, and they weren't allowed to take financial statement benefit due to the fact, even if they'd received the cash, it seemed dubious that they actually qualified. All right, let's go to the next. All right, Deb, you want to go here? It's your slide. And you're muted.
I'm sorry. This is interesting. The IRS, as sort of reviewing everything that's there during this moratorium, they came up with 20,000 ERC claims that are going to be disallowed, and they sent 20,000 letters out saying, we deny your ERC claim. I haven't seen any of those letters, but the publicity that the IRS released noted that the claims were denied because the IRS figured out that there were no employees in the year of the claim, or that the employer was not in business in the year of the claim.
Mhm.
So obviously, when you have employees, you have to pay employment taxes. And so it's easy for the IRS to check and see if there are no employees. And if you're not in business, the IRS can easily check when you start your business, when you start filing tax returns, things like that. When you get an employee identification number, all those kinds of things is all in their records. So they are whittling down and coming up with 20,000 claims that they're just going to disallow without looking at anymore based on the information that they have.
And I don't blame them. And I'm glad that they did that, honestly, because I think their focus there is the right focus, because that's clear fraud and abuse, or just like, not knowing what to do. I would barely know how you would file for it, honestly, without having ever filed a 941 in the first place. But it's interesting that this happened. Okay. Well, that happened recently. I'm glad the IRS is focusing there. It also gets rid of some of the backlog that they had too.
But as I say, I haven't heard that the IRS has not said they're going to ask for more information. But when I think about the easiest way for them to kind of not pay out claims that they're not sure of is to ask for more information, and the employer is going to have to respond with the additional information they ask for.
And just practically speaking, for our audience, we've worked with, probably over 1,100 companies right now in terms of the employee retention credit and making claims. I think we've only gotten very specific questions back on like 4 or 5 to date. And so it's interesting that the IRS method was really to just pay those claims out and wait to ask questions later. And they still haven't answered that many questions that we've seen. Now we will see, I guess the timing is important too. In the moratorium, they articulated too that it may take longer than it was to get a claim paid back. They were saying something like 90 days. Now it's up to 180. I would really say that at this point, we don't know what it will be, but I would not count on it being faster than probably 9 months after you file. So just a little extra there.
Yeah.
Okay. All right, we covered this last time, Deb, but
well, so if you have a claim and you were not confident, or you're sure it doesn't qualify, and the IRS is giving you the opportunity to withdraw that claim without any penalty. And it's a pretty straightforward way to withdraw the claim, which we'll get into in a minute. But just anecdotally, I understand that the IRS is not happy with the fact that people are not withdrawing claims. I have talked to some accountants who, as they're getting ready to, as they're working with clients, for example, they told clients they didn't qualify for the claim, and then the client filed for the claim anyway. And now they're looking more and they still believe the client doesn't qualify. And then they are helping them through the claim withdrawal process in order to avoid all penalties. So there's 3 situations at the bottom of the slide. You can see it's limited. You cannot have received a refund or been notified that the claim is under audit. You can't have received a refund. Well, there's 3 situations in which you can get the claim. You haven't received a claim, and either you're under audit or you're not under audit. So even under audit, you could use this withdrawal feature. And then that you received a refund check and you haven't cashed it. In addition, you have to be withdrawing the entire, I think this is on the next slide, you have to withdraw the entire amount of the claim. You can't say, oh, well, I did make one mistake. I included 4 people who were owners and they shouldn't have been included with the credit. And therefore, you can't, they will not let you partially withdraw. So the withdrawal, we want to go to the next slide. The withdrawal process is kind of unique. I've never seen anything like this before, but basically you take the form that you use to file the claim, you write withdrawn in the left-hand margin in the first page, and in the right-hand margin of the first page, you sign it as an authorized signer, you date it, you put your name and the title. The IRS says the biggest problem they have with withdrawn claims is that nobody signs that they want to withdraw. So you have to just sign in the margin on the left-hand side or on the right-hand side. You've written withdrawn on the left-hand side. And then you fax a copy of that withdrawal, of that return that you're withdrawing, that where you've written withdrawn and where you've signed it, to the fax number on the screen. That's fax number is exclusively set up to take withdrawal claims. And of course, keep a copy for your records if you're gonna withdraw your claim. Now, if you've not received a claim but you're under audit, then of course it's like any other time when you're under audit and you know there's something wrong. You need to come forward to the IRS and tell them, you know, I've got this issue. Well, in this case, you would come forward and say, hey, we want to use the withdrawal process to withdraw this claim. The IRS is more than happy to take that, because they're not going to do any work and the claim is closed. And even if you haven't been assigned an agent, so there's no one to talk to, you could just send your notice back, the notice that you get that says they're getting ready to come out and audit your tax return, and tell them that you're going to withdraw. So
go to the next
but
one.
the very last one is you've received a check but you haven't cashed it. So now it's a little bit different process, but it's what you would expect. You write void on the check, you mail the check back, and you make a copy of all of that, and then do the ERC withdrawal and say why you're withdrawing so you do the same thing you would do that if you were going to fax something, but because you have to include a check, then you have to write a letter and explain the reason you're returning the check, and the check is voided. And then there's an address to mail everything to. And of course, track your package, so everybody knows the date that something happened.
And then, Deb, the question becomes, what if you did cash the refund check? What happens then?
Okay, so if you did cash the refund check, you can amend your tax return. And in fact, we have audit clients who we determined that they did not qualify, and therefore they do an amended return to pay back the claim. And the IRS is working on a settlement program right now, and the settlement program has not yet been released. So what I tell most clients is I would not file the amended return repaying the ERC until we see what the settlement initiative says, because the settlement initiative may have some faster processing, it may have some other rules you want to comply with, but in general, there will be a settlement program. They said it was going to be issued this fall, and I guess we have another week of fall or so, but we haven't seen it yet. And you do definitely need to file the amended return paying back your ERC claim before the statute of limitations, right?
And anecdotally, I think, Deb, you and I have both heard from different sources or just reading that there's some discussion of some kind of, we'll call it grace settlement, where the taxpayer may not have to return the amount paid to the promoter in that particular case. I've at least heard that talked about a little bit. So it's interesting to me that would ever apply, but it's been talked about because there were so many promoter fees out there. I'm sure they'll go after the promoter.
Yeah, I personally think it's a very bad idea, because it basically gives future promoters carte blanche that, you know, all the people that pay them aren't going to lose their fees. But I think some people feel in the government feel sorry and maybe a little responsible for the fact that taxpayers were sort of scammed, and now they're out the money of whatever they paid the promoter.
Yeah, and I would just say as well, like in no way do we think that the employee retention credit program was bad. It actually helped a number of taxpayers, and if you qualify for it, you should apply for it. It's there for you. It's just due to the time it came out, the speed with which those refunds were provided, it attracted a number of, I won't say unscrupulous, but like aggressive promoters out there that talked a lot of taxpayers into claiming, which caused this backlog. But if you do think you qualify and you do think you haven't really looked at it in detail yet, please do, and we're happy to look at it for you. We're taking into account all of this background, IRS, the way they're looking at things as well. Our focus is on documentation and making sure you claim or making sure you qualify for it. But let's move to the next. I think it's a polling question next. Excellent. Polling question 2. I get the easy slides. Do you think you may be able to claim the employee retention credit but have not yet filed for it? Yes, no, or I don't know. We'll give 35 seconds, a minute, whatever to claim this, but we'll wait on that for a moment. Yeah. And then in a second, after we wait on the polling question, we're going to talk a bit about IRS exams and what we're seeing and what we're hearing about as well. I think what we're seeing is limited due to the fact that Deb has a lot of connections where she will be in contact with other firms and law firms as well, and providers where they're potentially working out and talking about the landscape of overall IRS defense. Our experience at Cherry Bekaert has been, thankfully, I would say somewhat limited on this, but we will get into what the standard information document request is from the service, which is essentially most of what, if not all, of what we put into our deliverables such that we have most of that data. All right, so the biggest was you may not be able to claim. No, so I think a lot of people have made that determination they don't, and I don't know is 29%. So perhaps an opportunity to take a look at it. All right.
Well, and we've run into some people who said to us, I didn't file for the claim when it first came out because I didn't feel like I really needed it. And of course, the PPP loans, you had to certify that you needed it. And so people were getting the rules mixed up a little bit. But now those same taxpayers are saying, you know what? I really do need that ERC money and I'm still entitled to it. And so they go back and claim it now.
Yep.
And then we have other taxpayers that say, oh, thank heavens we got this ERC. I don't know how we would have made it if we weren't able to file this ERC because we were truly, on the brink of bankruptcy and the money was helpful. Money seemed to come a lot sooner in the early part of the program. And I know that was the government's modus operandi. It was get the money out into the public. And there were some people within the government saying, we got to be careful. We got to be careful. We got to make sure people qualify. And higher ups were saying it's more important to get the money out in the public. So here we are with IRS exams.
Yeah. So, so I'll talk a little bit here and then add some color here, but like, the overall climate, who will be audited? I see this thing here. You alluded to it earlier. I think the IRS has some not too difficult things on which they can rely. For example, businesses a business who does not appear to have a drastic decline in its revenues in 21 or 20 compared to 19, who is somewhere in an area where they know that the government orders were not particularly onerous, who is also in a particular industry where they think, especially like tech or IT, where everybody can work remotely. That's like one thing, and this is speculation, but I have a feeling that that's one of the things they will be looking at. And it also, I just think when they're looking at companies that had an excessive growth overall in terms of like their gross receipts, but they still put in an employee retention credit claim. And then also I just say as well, Q3 of 2021 seems like something where because the mandates had been somewhat or drastically reduced by that time, a year and a half after COVID began, and you have a company with massively increasing gross receipts, I think they're going to put a hard push on Q3, and that statute of limitations for Q3 is open 5 years, not 3. That was one thing that they put in there to allow them to have the time to take a look at this. But what else are you seeing out there, Deb?
Well, one of the things we're going to see a lot of is for 2020 claims. if they think they want to audit them, my guess is that they will ask for an extension of the statute of limitations. And as with most general tax, if you're just regular tax audits, when the IRS asks for extension of the statute of limitations, it makes no sense to refuse it, because the IRS will just assess the tax before the statute runs, and then you'll be fighting that. So I would not be surprised to see a lot of requests for extensions, because we're coming to within 6 months of the expiration of the 2020 statute. There are also, so the statute of limitations for you filing returns is April 15th, but there's also a time that the IRS can go back if they've paid an erroneous refund claim. And that's 2 years after the claim's been paid. So just because you get paid, it doesn't necessarily mean that you qualify. And in fact, the IRS may not ask for a request of the extension because they have this erroneous refund claim provision.
And one of the things I wanted to bring up that I think we haven't published it yet, but wrote a little article on, was the concept of a company that made a claim for the employee retention credit, got their money, or was still waiting for it. And then at the same time, because you're required to reduce your deductions for wages in the amount of the credit, let's say back in 2020, and you make that reduction, that amended return, while you're waiting for the ERC money. And and then something happens where your ERC money gets claimed back, or you don't get it at all. The statute of limitations expires on your income tax return to go back and re-amend to add that deduction back in. There's a little bit of a mismatch in terms of timing around the income tax return and the payout of the from the 941X. What are your thoughts on that, Deb?
So I think we have a couple slides further on. We're spending a lot of time. In fact, later this afternoon, I'm going to be on a call with the IRS and suggest to them that there has to be some relief for taxpayers, because I think it's pretty clear you do have to amend your income tax return before the statute runs. And then if it's disallowed by the IRS, there are ways you can file a protective refund claim, perhaps, although that would be a lot of filing on the part of the IRS, and it would be a lot easier if the IRS would just allow people to adjust their income tax returns even after the statutes run. And I personally think they could come to some analysis where that they could issue that kind of a notice, but we'll see. We're pushing on them to do that.
All right. Okay. So how to prepare for an IRS exam if you already claimed the ERC. Basic risk assessment, right? And what's happening to us now is we're not only preparing new employee retention credit claims, but also getting quite a bit into the analysis of those that have claimed, and maybe taking a second look to see what their overall risk assessment was. And so I think with the benefit of hindsight and all this IRS, I won't say clarity, but I will say additional articulation of certain thoughts around supply chains and OSHA guidance and just the experience, you can take a better, and we can really take a better assessment of whether or not the company was an eligible employer in the first place. Generally speaking, we can quickly take a look at whether the calculations are correct. And then I think most importantly, get a sense of whether the company forgot to think about the fact that the owners owned another business that should have been included in the attempt to qualify the business. You have to look at things on a control group basis. Beyond that, and this is in most of our all of our deliverables, but are the calcs correct? Making sure you have a specific summary of the government orders, how they affect the business, understanding when PPP was forgiven, and making sure that that interplay of ERC and PPP wages, that there's no overlap there. Generally speaking, there is often enough wage that PPP funds that would never have gone into an ERC anyway. So there tends to be enough excess wages such that the PPP and ERC doesn't always cause either to decline, especially that ERC to decline, but you have to be very specific around that. And I think as well, R&D credits too in 2021, as we look for an employee retention credit claim. Technically speaking, you can't have $1 and 2 credits. You'd be better when you go back and do your amended return to reduce your deductions for wages for ERC to reduce your QREs for the R&D credit and keep those in the employee retention credit, because the statutory rate of credit is so much, I don't know, we'll say something like up to like 7 times higher than in the ERC than it might be in the R&D credit. So these are just some things to think about when we're preparing for an exam. And we'll go to the next one. And then,
well, I want to just highlight this proper documentation, because the IRS, what they don't want, what they want in addition to narratives about how your business was partially suspended, is they want specific facts that they can tie to third-party data or internal records that existed in 19. So if hospital, the beds in 2019 versus the beds in 2020 or 21, that, and the decline in beds, in occupied beds because of the mandates, and lack of elective surgery, for example. But the point is, now is the time to go back and get copies of the government mandates. They will want the actual mandates. They don't just want you to say Massachusetts Executive Order 2020-17. They want to see that order and they want to read that order. So you need to, if you relied on a government mandate, you need to get a copy of the mandate before it goes away from the internet. They want general ledgers, and in some cases, they've asked for bank accounts so they can tie the receipts that are in the general ledger to the bank accounts and to the amount that you're using to claim as an eligible employer. And third-party PPP loan forgiveness is almost pretty easy. Wage data is pretty easy. That's all usually third-party items, but we can move on.
Just working with an IRS agent, like some basics here, but just maybe don't do it yourself if you can't. Like engage with a professional. We're also here to help doing that. Deb especially does a lot of this and tends to get a lot of good with her history of Treasury, has a good working understanding of the way the IRS works, and can work well with an agent. One thing that we do as well is we have these deliverables that have as much data as we think. We try our best not to just throw that deliverable at the IRS agent, though. We want to be specific to the extent they've issued an IDR or asked a question that we can answer just that exact question. It may make things go more quickly as opposed to just throwing a big book at them. And then the potential to negotiate for less info to provide them to the extent it's excessive. I've even seen, Deb, one thing you mentioned about third-party data in the gross receipts analysis. I know there was some inquiry as to like whether or not just the internal books and records were enough. They actually wanted to maybe see what some bank account statement said about money coming in, and that became quite onerous. And so it was just interesting that they went that deep on that particular question around the gross receipts. Also, it's inconsistent in terms of what different agents are asking for. Some are new, some have been around, some really know what they're doing and want to get done. Some are, learning the system, shall we say. And so they're asking for different information at different times, different taxpayers in different positions. So you got to be ready for all of that. If no agreement, consider appeals at the end. Hopefully that's a last, worst case scenario. But I think there's a lot you can do by just being responsive to your IRS agent, answering them quickly, and engaging them, and not just essentially like letting it sit for a while. So let's move to the next. All right. So this is a bit of takeaway background, but these are the things that they ask for. This is 2 pages of information, a lot of which, and we've noticed this on like nationwide information document requests, but it's going to require, to the extent you claim an ERC, they're going to want the original forms 941. They're going to want your payroll journals. And there's an interplay with the FFCRA COVID sick leave credit and the employee retention credit that they tend to ask some of that data information at the same time. And so this listing of like people who were paid sick or family leave comes into some of the analysis of that credit as well here. you're going to want to get obviously your forms W-2 for 20 and 21. They're going to want to see your exact calculations, the overlap with PPP. Move to the next slide, please. They're going to want to understand exactly why you were partially suspended, what the government order was, the duration of the order, and how it had the effect on a more than nominal portion of your business. Essentially, all the stuff we're talking about, they want it. This is a factual position when it comes to utilizing these government orders to show that you had a partial suspension. You really need to show that you were partially suspended, partially shut down. And so that's more than just something basic like an overall OSHA guidance. And so you really need to apply the facts to your business. And some of that internal data where Deb talked about, say in the hospital context, how many people did you have in beds in 2019 in that quarter compared to the same quarter in 2021 or 2020 becomes very relevant for purposes of looking at this, but also very powerful when you have it, because so few do, or those that are unprepared won't have it. I think it'll be very impressive to the IRS that you have this internal data showing the facts. And that's what we've always focused on when it comes to our analyses here. The PPP analysis too, the overlay with R&D that we talked about as well. But again, also just most importantly, if there are any acquisitions or dispositions or something too, you're going to want to take a look at. So these are the general 20 questions that you want to be prepared for. Some of it's pretty basic. You'd have it in any ERC claim, getting that calc right, but a lot of it's the extra stuff that will make the difference when they ask a question. All right, let's move on. Fraud in the system. Okay, fun time. All right. So this slide actually dates back to earlier in the year, but it's when I started to see, and we talked about some of this already, but it's when I started to see things that the IRS has later articulated as warning signs. These were some of our warning signs. Avoid providers that rely on CDC and OSHA guidance. That's been in our slide deck all year. And so I'm glad the IRS has articulated something that we knew to be true. But also I think that was differentiating what we've been doing from some of the ERC mills out there. They're going to look for people who had increasing revenues. And this last one, avoid providers who rely solely on employer statements. Basically, if you claim the ERC and you had a third party, we'll call it ERC mill, do the calculation for you, and their reason for claiming it was just because you signed a form that said you qualified, they sort of like try to get off the hook that way to say, we educated you, you signed it, but then they don't actually sign the return. So then you have to sometimes go find another third-party accounting firm to do that for you. Anyway, the point is there should be a pretty decent, rigorous analysis by them as to why you qualify, and it shouldn't be you just signing a statement that you do. Let's move on.
Well, and Marty, I've heard situations in which the payroll companies sent a letter out and said, there's an ERC credit, check if you qualify and we'll file for you.
Yeah.
And people said, okay, I'll just check the box, and didn't really think anything about it. And payroll companies didn't ask anything. And now some of those are good candidates for the withdrawal process, because they go back and they look and they go, well, I checked this box, but I didn't really know what I was doing, and they sent me money. But now maybe I better check and make sure that I am entitled to that money.
Yeah, I think there's so much fraud out there that people who did qualify but maybe didn't do the analysis are hopefully not going to be bothered too much. I think there's a lot of people go after some of these like large employers claiming all the PTO, things like that I've seen as well. There's just a lot out there for the IRS to focus on. This first 20,000, I think it was a good hit. They'll start there on those that didn't have employers. Great, that's out of the system. Now they can't talk about it anymore, right? And so maybe the backlog's not so bad. They can find a few areas, I hope, that we'll go through, and then we'll clear the decks a bit for those that actually legitimately have the opportunity to qualify. But some other stuff to keep an eye out for. I think contingent fees are always something to look out for when it comes to this stuff. It just sort of it encourages, shall we say, the intention of a provider or promoter to increase the credit as large as possible to get that fee. I think really, and don't work with anybody who's not going to also sign the tax return. You can't do electronic filing for these, so it's going to have to be prepared by somebody. Don't do it with someone and then take it to someone else to do the filing. Have the person who is coming up with the analysis put their name on it, such that they will list themselves as the preparer for tax purposes. I think that alone should carve out anybody you wouldn't want to work with. And I've even worked with some CPA firms who like work with us where we'll do it, but that's because they didn't have the expertise. I think it's a good sign if your CPA says we don't have the expertise, find another CPA firm who does that. But again, I just wouldn't work with anybody who doesn't sign a return themselves with their name on it. Okay, let's move on. Polling question 3. We got to get through these polling questions. We got 8 minutes. Everybody wants this stuff. So here we go. Which of these may be warning signs? Fees based on a percentage of the credit claimed. Total reliance on an employer to determine if qualified for the ERC. A 2-minute online application process. We didn't really talk about that, but well, I get this. OSHA guidance as a government order or any of the above. Yeah, there's 2-minute online applications. If they're making a determination that you qualify in such a short period of time, highly untrustworthy. It takes more at times because there has to be at least some vetting of the gross receipts, even if it's a gross receipts test as well. Some analysis of whether or not the amount calculated includes the owners, which is not permitted to the extent they're more than 50% owners. And again, we talked about OSHA guidance as well as not being qualifying. So not to give the answer out, but I would say any of the above seem pretty bad to me. So we'll wait to see what people say when they do the rest. Well, when the results come in, and then I'm going to get through these last few slides such that we can get everybody to their 4th polling question, and also provide some quick guidance for you too. Okay, any above, right? Thank you for listening to me. I appreciate it. All right, guys, let's move on.
So the Office of Professional Responsibility issued an alert in July, alert 2023-002. And what they were basically saying is that a practitioner who signs an employment or an income tax return has to be confident at a reasonable, there has to be a reasonable basis for claiming this credit. Now, a reasonable basis is a pretty low level of authority. There can certainly be disagreements with the IRS. So there can be cases where you're going to claim a credit and have to amend an income tax return where to claim a credit and amend your income tax return to pay more taxes. And the government would not agree with that, but it's still a reasonable basis. So the people are, if you have a situation where someone's preparing an income tax they come to you and you have to amend their income tax return, or a CPA has to amend the income tax return, and there's no reasonable basis for claiming that credit. In other words, they claimed a credit for 12 employees and the CPA knows they've never had more than 3. So there's no reasonable basis given what the CPA knows. So in that case, the CPA really needs to talk to that person about the fact that the credit they claimed and actually probably got already is not reasonably theirs. And if the client comes back and says, well, I'm not going to give it back now, let them come and find me, then the CPA really needs to decide, both on our AICPA guidelines and because of the IRS Office of Professional Responsibility highlights that you need to think about withdrawing from that client and not doing any more work for it.
Yeah.
And then on the next slide, which I don't
want to, counterintuitive, right? Because like generally speaking, you're reducing deductions, which increases the amount of taxable income, which you wouldn't think would have any kind of abusive potential. But in this case, you could be perceived as perpetuating a fraud to the extent there's no reasonable basis for that. And so it's just an interesting interplay between payroll tax and income tax, and it almost never happens.
Right.
All right, let's move on. Yeah.
Okay, what happens if you file your income tax, you pay your income tax for 2020, and then your claim's disallowed? Well, you can file what's called a protective refund claim. And in the protective refund claim, you are sending an amended tax return and asking for a refund of an amount to be determined later. And that amount, of course, is going to be determined by what the IRS could disallow. So it protects you from the statute of limitations running. Now, there's some question as to whether a protective refund claim can be used in this situation. And we're hoping to get some IRS guidance that either confirms that it can, or a better way to do it than a protective refund claim. But for right now, the only thing you can do is file a protective refund claim. So I think that gets us to the next polling question.
Almost. So this is just this was something else that came out earlier this year. To the extent the IRS made an ERC overpayment, it's actually treated as an underpayment of tax for the taxpayer. That was clarified in some of the guidance earlier this year. That was unclear. But let's move to the next. And I think it might be the last one. All right. Would you like to learn more about how we can help moving forward? Sure thing. With that said, if you actually want to know anything about the employee retention credit, specifically with respect to your company or someone else you may be representing, we're more than happy to have that discussion with you. We're doing a lot of work, writing articles, a lot of work with some law firms out there, working just still filing these claims on behalf of taxpayers. So yes, no, or maybe in the future. So we shall see how this comes up, but whatever it comes up, we're more than happy that we had the opportunity to talk to everybody today. This is the last one that we're obviously doing for this year. I would imagine, though, we'll probably do an ERC podcast, maybe not in January, but I would imagine February, because I expect the moratorium to hopefully be close to ending by the time February 1st rolls around, or maybe we'll know something. We may also know something about specific programs from the IRS around like returning funds or settlement programs as well. We're going to get a lot more clarity here. And technically speaking, we probably have another year and a half of the employee retention credit for 2021 being around. So I haven't listened to a tax podcast or talked in anything internally that didn't involve some amount of ERC. It's been interesting. It's been helpful. We've gotten to know a lot of clients, and I've certainly gotten to work with Deb, which has been great for me and my career. It's been wonderful. All right, so let's see what our results here are, Maggie and Lindsay. And the answer is, doesn't matter. It doesn't come up. I remember that. There you go. Okay, so on the last one. Anyway, the point is, I think it's been clarified a lot what's on ERC, but for those that need help, let me know. This concludes the last session of the series. Thank you again for joining us. If you have additional questions, regarding today's topic, please reach out to Deb Walker or me. Also, just please, when you think about ERC, work with a reputable accountant, CPA firm, etc., and try to avoid the consultancies that don't sign the return. Thanks for your feedback. We value it. And we're going to take part in the survey at the end if you want to. So thanks so much for joining. Appreciate it.